In today's episode of the Daily Brief, I'll talk about two interesting stories. I first talk about the transformation of global financial systems, and finally, I talk about the plastic and pipes industry. Welcome back to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host Akshara, and today is Wednesday, 2nd July. Today, we're diving into something that's quietly reshaping the entire global financial landscape. It's a story that affects every investment decision, every currency trade, and economic policy decision being made around the world right now. So let's dive in. In the recent BIS annual economic report, the Bank for International Settlements, think of them as the central bank for central banks, had a fascinating chapter on the structural transformation of the global financial system. And when I say transformation, I mean, we're talking about changes so fundamental that they're rewriting the rules of how money flows around the world. So, what exactly has changed? Well, imagine the global financial system as a massive highway network. For decades, the main routes were dominated by traditional banks lending to businesses and consumers. But since the great financial crisis of 2008, we've seen two seismic shifts that have completely altered this landscape. First, global investors have fundamentally shifted their focus away from lending to private companies and individuals towards financing governments. Instead of funding businesses and consumers, these massive institutional investors are now primarily buying government bonds. The numbers here are staggering. Since the great financial crisis, claims on governments have gradually become the main driver of overall credit growth, overtaking credit to the private sector. Government bond issuance has grown at a considerably faster pace than both loans and corporate bond markets. While private sector lending has grown modestly, government bond markets have exploded in size, fueled by massive fiscal deficits and, of course, the pandemic era spending spree. The second major change, non bank financial institutions have become the new titans of global finance. Now, when I say non bank financial institutions, I'm talking about pension funds, insurance companies, asset managers, and hedge funds. These aren't your traditional neighborhood banks. These are massive institutional investors managing trillions of dollars, and their total assets have grown from 167% to 224% of global GDP between 2009 and 2023. Meanwhile, traditional banks? They've grown much more modestly from 164% to just 177% of global GDP over the same period. Now, you might be thinking, okay, so what? Different players, same game, right? Wrong. This transformation has created an entirely new financial reality with profound implications that reach far beyond Wall Street. And here's the thing, when banks were the dominant players, they primarily operated within their home countries. Sure, some big banks had international operations, but the bulk of lending was domestic. Financial conditions moved relatively predictably within national borders. A central bank could adjust interest rates, and the effects would ripple through the domestic banking system in fairly contained ways. Think of it like ripples in separate ponds. But these new players, they're fundamentally different beasts. A European pension fund doesn't just invest in European assets. They're actively hunting for yield across the globe, buying US treasuries, Japanese bonds, emerging market debt, you name it. And here's what makes this transformation so significant. These institutions manage absolutely enormous pools of capital. We're talking about pension funds and insurance companies with hundreds of billions under management. This global reach has fundamentally changed how financial shocks transmit across borders. Remember, these aren't just passive buy and hold investors. When risk appetite changes, say when investors suddenly become worried about inflation or geopolitical tensions, these massive funds can shift billions of dollars between countries and asset classes almost instantaneously. And the result? Instead of those separate financial ponds with occasional spillovers, we now have a vast interconnected ocean where a storm in one region can create waves that crash on shores thousands of miles away. One decision made by a fund manager in London can instantly affect bond markets in Tokyo, currency values in Sao Paulo, and borrowing costs for companies in New York. But here's what's really remarkable: this isn't just about size and speed. The BIS research shows that this new system has made financial markets much more sensitive to changes in what they call risk factors. Essentially, how willing investors are to take on risk at any given moment. When global risk appetite shifts, it now moves through the entire system. The financial world has become dramatically more connected, and that connectivity is a double edged sword. On one hand, it means capital can flow more efficiently to where it's needed most. On the other hand, it means that financial stress can spread faster and more broadly than ever before. Now, this is where the story gets really interesting because none of this global investment activity would be possible without a financial instrument that most people have never heard of but has become absolutely crucial to the modern financial system: the FX swap. Let me break this down with a simple example. Imagine you're a European pension fund with obligations to pay retirees in euros, but you want to invest in US Treasury bonds because they offer attractive yields. Now, here's your problem. If you buy those dollar denominated bonds with euros, you're exposed to currency risk. So, what do I mean by currency risk? Well, if the dollar weakens against the euro, your investment could lose money even if the bond itself performs well. Enter the FX swap. It's essentially a financial contract that lets you have your cake and eat it too. You can invest in that US Treasury bond while hedging your currency risk. And here's how it works: you enter into an agreement where you exchange euros for dollars today at the current exchange rate, then use those dollars to buy the bond, and simultaneously agree to exchange dollars back for euros at a predetermined rate when your investment matures. It's like having a currency insurance policy. You get the upside of the foreign investment while protecting yourself from exchange rate movements. So, if that US Treasury pays 5%, you can lock in a known return in euro terms regardless of what happens to currency exchange rates. Now, here's the kicker: the FX swap market has become absolutely massive. We're talking about $111 trillion in outstanding contracts by the end of 2024. And to put that in perspective, that's larger than the entire global stock of cross border bank credit and international bonds combined. And roughly 90% of these swaps have the US dollar on one side, which tells you just how central the dollar remains to global finance. What's particularly interesting is that the fastest growing segment has been in contracts with non bank financial institutions. They've nearly tripled in size since 2009. But here's something that might surprise you. Over three quarters of all these FX swap contracts have a maturity of less than 1 year. That means this massive market is constantly rolling over, creating a dynamic that can amplify both stability and volatility in global markets. So, what does all this mean for financial conditions around the world? Now, when I say financial conditions, I'm talking about how easy and expensive it is for businesses, governments, and individuals to borrow money and access credit. This is where the story takes a fascinating turn because we're seeing something that challenges conventional wisdom about monetary policy and financial markets. Traditionally, we thought of financial conditions as primarily domestic affairs. The Federal Reserve sets interest rates, and that mainly affects US financial conditions. The European Central Bank makes policy, and that mainly affects European markets. Simple, right? But this new globally interconnected system has turned that logic on its head. The BIS research shows something remarkable. Financial conditions are now transmitted across borders much more strongly than before. And this transmission flows in multiple directions now, not just from the US outwards. So, what do I mean by that? Well, it used to be that when the Federal Reserve sneezed, the rest of the world caught a cold. US monetary policy was the primary driver of global financial conditions. But now, US financial conditions are increasingly affected by developments in other advanced economies as well. It's become a two-way street, or really a multi lane highway with traffic flowing in all directions. Let me give you a more concrete example from the report. Remember the yen carry trade that made headlines in August 2024? Japanese investors had been borrowing cheaply in yen and investing in higher yielding assets elsewhere. When that trade unwound suddenly, it didn't just affect Japanese markets. It transmitted financial stress directly to the United States, demonstrating how interconnected these systems have become. And here's another striking finding. The BIS research shows that the cross country co movement of government bond yields and corporate spreads has increased significantly in the recent years. When we look at financial market connectedness, which essentially measures how much of market movements can be explained by transmission across countries rather than domestic factors, we see that over 60% of risk factor variability could be explained by global connectedness during the pandemic. That's up from below 50% during the great financial crisis. And what's even more fascinating is that foreign private sector investors, mainly these non bank institutions, now hold more than half of all foreign holdings of US treasuries. Think about that. The world's most important bond market is increasingly in the hands of global asset managers, not just foreign governments. But here's what's really important for anyone trying to understand where markets are headed. This interconnectedness means that domestic monetary policy has become more complex, but it hasn't become powerless. The research shows that while external factors now have a significant effect on financial conditions, domestic monetary policy still retains strong influence, especially over government bond yield curves. What this means in practical terms is that central banks can steer their domestic financial conditions, but they now have to be much more aware of what's happening globally. They can't just set policy in isolation. They need to consider how their decisions will reverberate through this interconnected web and how foreign developments might affect their domestic objectives. This creates both challenges and opportunities. On the one hand, it's harder for central banks to achieve their desired financial conditions when global forces are pulling in different directions. On the other hand, this connectivity means that coordinated central bank actions can be more powerful than ever. The report also reveals something crucial about monetary policy effectiveness. While global spillovers have become more powerful, domestic monetary policy hasn't lost its punch. When central banks adjust policy rates, they still have significant effects on domestic government bond yields, often exceeding the spillover effects from abroad. But here's the catch. Risky assets like stocks are now more heavily influenced by global conditions than domestic policy, especially in emerging markets. See, we're living through a fundamental transformation of how global finance works. The old model of largely separate national financial systems has given way to a highly interconnected network driven by massive institutional investors using sophisticated hedging strategies. Now, coming to the next story. We came across this report from Motilal about the plastics and pipes industry. And since we've never really covered this industry, we thought now would be a really good time to look at it. Like many sectors in India, it's moving from an unorganized, hyperlocal setup to one that's more brand led, formal, and quality driven. It's changing how homes are built, how water reaches your tap, how farms get irrigated, and how cities lay down their sewage systems. At the heart of this transformation is a surprisingly complex supply chain, one that starts with two basic raw materials, salt and crude oil. The most common material used in pipes is PVC or polyvinyl chloride. To make PVC, you need chlorine, which comes from salt, and ethylene, which comes from oil. When these two react, they form VCM, which is vinyl chloride monomer, which is then polymerized into PVC resin. That resin becomes the base material for plastic pipes. Companies mix this resin with other additives to make a usable compound, which is then molded into pipes and fittings. Now, here's the key bit. Most Indian pipe companies don't control this entire chain. They usually buy resin either from domestic suppliers like Reliance and Chemplast Sanmar or import it. Only Finolex Industries is fully backward integrated. They make their own VCM and PVC resin. That gives them more control over cost and supply. But others like Supreme and Prince focus only on the mid to downstream segments compounding, molding, branding, and distribution. And that's why resin prices matter so much. When crude oil prices spike or supply chains get disrupted, resin prices go up. Companies either pass on the cost to customers or absorb the hit. But there's often a lag, especially in agriculture or infrastructure, where you can't immediately hike prices. That lag squeezes margins, and when resin prices crash, companies holding expensive inventory take a hit. So the industry's profitability is tightly linked to resin price cycles. So, what kinds of pipes are used? The Indian plastic pipes industry is dominated by four main types. Unplasticized or PVC, which is 64 to 65% of demand, used in irrigation, cold water plumbing, and drainage. It's cheap, easy to install, and corrosion resistant, making it the go to for agri and rural use. Next, chlorinated PVC, which is 15 to 16%. This handles hot water, lasts longer, and is used in residential and commercial plumbing. Costlier than UPVC, but offers better margins. Third, HDPE, around 15%. Used in underground drainage and infrastructure, it's flexible, strong, and long lasting, which is ideal for cities and public utilities. Fourth, PPR, 4 to 5%, which is a premium pipe for hot and cold water in high end or industrial setups. It's durable but needs specialized installation, so adoption is limited. In short, UPVC drives volume, CPVC drives margin, HDPE is infra focused, and PPR is niche. Most companies try to balance these to optimize both scale and profitability. So, where is the demand coming from? The biggest chunk, which is around 45%, comes from irrigation and agriculture. Indian farms are shifting away from open canal irrigation to more efficient drip and sprinkler systems, and that shift needs pipes. The second largest segment is real estate and plumbing, which makes up around 39%. Every home, building, and office needs drainage systems, plumbing, and hot cold water lines. As urban India grows, so does this segment. Sewerage and infrastructure projects like underground drains account for another 12%, and the rest comes from miscellaneous uses. What's interesting is that even when new construction slows down, the industry still sees steady demand because the 30% of the market is still driven by replacements. Older GI pipes or galvanized iron pipes rust. Even some older PVC installations degrade over time. So, whether or not you're building something new, repairs and upgrades keep the volumes flowing. A huge part of the growth in plastic pipes isn't just coming from homes or farms, it's coming from the government. So, in the past few years, the Indian government has launched massive infrastructure programs that require millions of meters of piping. The Jal Jeevan Mission, or JJM for instance, aims to provide functional tap water to every rural household by 2028. As of now, 81% of homes have been covered, but over 37 million households still need to be connected. That last leg alone can drive enormous pipe demand over the next 2 to 3 years. Then there's PMAY, the Affordable Housing Scheme targeting 49.5 million Pakka homes, and Amrit, which is modernizing urban water and sewerage systems in hundreds of cities. Add to that Namami Gange and smart cities, and you get a scale of public sector demand that's hard to ignore. Even on the agri side, the Pradhan Mantri Krishi Sinchai Yojana, or PMKSY, which focused on irrigation, saw a 25% budget hike this year, with Rs 8,300 crore earmarked for micro irrigation and water use efficiency. And this matters because despite progress, nearly 48% of India's cultivated land is still rain dependent. Bringing these areas under drip or sprinkler irrigation means one thing: more pipes. Put simply, government money is pouring into water, sanitation, and irrigation, and almost all of that flows through plastic pipes. Now, this entire shift is built on the rise of plastic pipes. A couple of decades ago, India relied heavily on metal pipes, steel or GI. These were bulky, expensive, prone to rust, and difficult to transport. Plastic pipes, PVC, CPVC, HDPE, changed all of it. They're cheaper, lighter, last longer, and don't corrode. For a country like India, where infrastructure has to grow quickly and affordably, this shift has been massive. To give you a sense of scale, the core plastic pipes market is already worth over Rs 54,000 crore as of FY24, and it's expected to grow at 14% annually, potentially crossing Rs 80,000 crore by FY27. But that's just the pipes. If you include adjacent categories like water tanks, bathware, adhesive, paints, and packaging films, the total addressable market balloons to Rs 2.72 lakh crore. Now, here's what makes the space even more fascinating: the industry is consolidating. This was once an extremely fragmented market, dominated by hundreds of small, local manufacturers. These players mostly made basic agricultural pipes sold within a limited region, with little focus on branding or product innovation. Margins were thin and operations were informal. But over the last 10 to 15 years, that's been changing fast. Today, the organized segment accounts for about 70% of the industry, up from just 50% a decade ago. The top 5 companies control roughly 40% of the total market. And the reason is simple: larger players offer consistent quality, better warranties, more variety, and importantly, better reach. And there's another tailwind for the big players: trade protection. In 2020, the Indian government imposed something called an anti-dumping duty, basically a penalty tax on CPVC compounds imported from China and South Korea. These compounds are a key raw material used to make hot water pipes. The idea was to stop cheap imports from undercutting domestic manufacturers, and that duty was supposed to last 5 years, but the government recently extended it till 2029. Now, most small unorganized players in India don't make their own CPVC compounds, they import them. So, this duty makes their raw materials more expensive. Big players like Astral or Prince Pipes, who either make their own compounds or have reliable local tie ups, aren't affected as much. That gives them a pricing and margin edge. There's also talk of a similar anti dumping duty being added on PVC resin, another core input for regular pipes. And if that happens, it'll hit import reliant players even harder. In short, government policy is quietly tilting the playing field in favor of large, well integrated domestic brands. It's becoming harder and costlier for small players to compete. Since pipes are bulky and expensive to move, having manufacturing plants near demand hubs is crucial. And that's why most top companies now have multiple factories spread across India. So, who are the big players? Let's start with Supreme Industries. They're one of the oldest, most diversified, and biggest names in the sector. Their product range covers everything: PVC, CPVC, HDPE, PPR, pipes, fittings, valves, tanks, and even plastic furniture. With nearly 30 manufacturing plants and a deep distribution network, they lead the industry in both value and volume. Astral is best known for premium CPVC pipes used in hot water systems. They were early movers in this segment, have built a strong brand around quality, and also diversified into adhesives and sealants. They're arguably the most profitable player in the space with the highest margins per kilo sold. Then there's Finolex Industries, a strong player in agri pipes. What sets them apart is their fully backward integrated model. They manufacture their own resin starting from VCM, giving them an edge in cost control and supply security. Their distribution is deeply entrenched in rural and semi urban India. Prince Pipes is a relatively newer entrant but growing rapidly. They've built a wide product range, tied up with global leader Lubrizol for CPVC compounds, and invested heavily in branding and plumber outreach. They're the fast challenger in the space. Each of these companies has carved out a niche. Supreme leads in volume and diversification, Astral dominates CPVC and fittings, Finolex is strong in agri, and Prince is making inroads into plumbing and bathware. But there's another question that needs answering. Who actually picks the pipe brand? Most of us don't. The decision is usually made by the plumber, contractor, or architect, people who understand technical specs, have hands on experience, and maintain relationships with local dealers. That's why pipe companies focus heavily on plumber loyalty programs. Astral has a dedicated loyalty app. Prince's Udan program has over 1.6 lakh plumbers enrolled, rewarding them with points, cashback, and even trips. The idea is simple: if the plumber trusts your brand, he'll push it. So, what do we have here? A high growth industry with a long runway. Strong tailwinds from agriculture, urbanization, and replacement demand. A shift from unorganized to organized. Clear leaders with distinct strategies, and steady expansion, both in product range and distribution reach. Every new home built, every farm that switches to drip irrigation, every old pipe replaced, that's another few meters of plastic pipe sold. And increasingly is coming from one of a handful of formal players who have turned this once fragmented industry into a consolidated, brand driven business. Now, coming to the first tidbit, we have an update on our recent story on hospitals. Apollo Hospitals plans to separate its digital health and pharmacy business, including its online platform Apollo 24/7 and pharmacy distributor KMed, into a standalone unit within the next 18 to 21 months. Shareholders will receive additional shares in the new entity, with Apollo maintaining a 15% stake and influence on the board. Coming to the second tidbit, we've looked at China's dominance in rare earth elements and how that relates to magnets and our domestic auto sector, and there's a new development. Sona Comstar, India's largest importer of rare earth magnets, plans to establish domestic production to reduce reliance on Chinese imports, following China's export restrictions in April. The company, which supplies components to automakers like Tesla and Stellantis, imported 120 metric tons of magnets from China in the last financial year and is exploring local manufacturing options in alignment with India's new incentive program for critical minerals. Coming to the third tidbit. The world of AI is constantly growing, and we just published our monthly roundup of all the developments. But in the few days since then, there's more. Apple is considering integrating large language models from Anthropic or OpenAI to enhance Siri, moving away from its in house AI models. Discussions are underway to adapt these models for Apple's cloud infrastructure, aiming to improve Siri's performance. Coming to the fourth tidbit. We've written not one, but two stories on India's curbs on imported steel, and the story continues to evolve. India has extended its import curbs on low ash metallurgical coke for another 6 months, from July 1st to December 31st, 2025. The new restrictions cap imports at 1.4 million metric tons, with country specific quotas as part of efforts to promote domestic sourcing and reduce reliance on imports from countries like China and Japan. This move follows a previous 6 month restriction period that began in January 2025. Now, coming to the fifth tidbit. We covered the Taiwanese dollar's over 6% jump in just 2 days back in May, and the currency seems to have created waves again. The Taiwan dollar surged over 2% in a single day, marking its most significant gain since May amid heightened market volatility. This rally, driven by exporters' US dollar sales, has raised questions about the central bank's tolerance for the currency's strength. That's all the news I have for you today. Thank you so much for watching and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.